Republican lawmakers released the details of their tax code rewrite on Friday, which reconciles differences between the House and Senate bills. Several of the most anticipated changes, such as a significant increase in the standard deduction and the curtailing of state and local income tax breaks, made the final cut. Some of the most controversial proposals, like eliminating the medical deduction, were wiped away. Many of these provisions are temporary, however, and are set to expire after 7 years. Now 7 brackets, with a top rate of 39.6%, which people pay on income they earn beyond $470,700 for couples filing their taxes jointly or $418,400 as an individual. New plan 7 brackets, with a top rate of 37%, which married people filing jointly will pay on income they earn in excess of $600,000. If you're single, the top rate applies to income earned beyond $500,000. Now if you're single, the standard deduction is $6,350. Add in exemptions, and you're up to $10,400. Married without children. That's $12,700 for the deduction and $20,700 with exemptions. If you're married with 2 children, the deduction plus exemptions figure goes up to $28,700. There is also a $1,000 tax credit per child. New plan: the standard deduction is temporarily increased to $12,000 for singles and $24,000 for married couples filing joint returns. The child tax credit is increased to $2,000 for each child, and up to $1,400 of that can be delivered in the form of refundable credit, which means taxpayers can receive money back even if they have no tax liability. Taxpayers may also reduce their tax bill by up to $500 for other dependents who are not children. But that all changes in 2025, when the deductions and exemptions revert to current law. Now you can generally deduct the amount you pay for state and local income taxes, including property taxes, on your federal income tax return. You can also deduct the interest you pay each year on mortgage debt up to $1 million, a cap that can cover multiple homes. Plus, you can generally deduct up to $100,000 in interest you pay on a home equity loan or line of credit. New plan: taxpayers may deduct only up to $10,000 total, which may include any combination of state and local taxes, including property taxes, also sales taxes. But don't try to prepay your state and local income taxes before year-end to circumvent the new limit. The proposal is one step ahead of you and your accountant and won't allow it. You can also deduct the interest paid on mortgage debt up to $750,000. But if you bought a property before December 15, you can still deduct interest up to $1 million, the limit under current law. Home equity loan interest is no longer deductible for anyone. Now you can deduct out-of-pocket medical expenses that exceed 10% of your adjusted gross income, but not the expenses that amount to the first 10%. This is particularly useful for elderly people and others with lower incomes who need regular assistance and care. New plan: in 2017 and 2018, you can deduct out-of-pocket medical expenses that exceed 7.5% of adjusted gross income. Now under the Affordable Care Act, individuals must buy a qualifying health insurance plan or pay a penalty, unless they qualify for an exemption.